Good evening, viewers. Accounting Equation Academic Channel presenting third video class on the topic of cost of preference share capital under cost of capital of financial management. So, welcoming all the viewers in this channel, and today's I am your this presenting this topic, cost of preference share capital. This is another important source of funds for a firm to raise the capital. So this is different from equity share capital on account of two basic features, namely the preference shares are entitled to receive dividend at fixed rate to preference shareholders, which is fixed rate. So preference share capital is also calculated from perpetual and non-perpetual point of view. Perpetual means non-redeemable, irredeemable, and non-perpetual, that is redeemable. Basic feature of preference share is that the rate of dividend is predetermined, and if it is redeemable, period of maturity is also predetermined. Accordingly, a firm issue the preference share. So redeemable point of view and non-redeemable point of view, it is calculated similar to your cost of debenture or cost of debt. But as the preference shares dividend which is paid, it is a appropriation of profit, unlike interest on debenture, which is a charge against profit. So this is an appropriation of profit. Preference dividend an appropriation of profit, so therefore the adjustment of tax is not required because the tax benefit is not available on the payment of preference dividend. It is an appropriation of profit. That is, after net profit, the balance of net profit available after tax, the profit available after tax, out of this profit preference dividend is paid. So that is, the tax benefit is not available. It's calculated similar to debentures. Debentures are perpetual and non-perpetual, redeemable. So when, and in the same manner, the cost of irredeemable preference capital can be calculated using the formula as KP. P stands, it is indicating for cost of preference capital. D by NP into 100. So dividend by net profits. Okay, so dividend by net profits. And a D is annual preference dividend and net profits of preference shares. So here the face value plus premium minus cost of flotation or cost of issue is, in this way we calculate the net profits. Or if the shares are issued at a discount, then face value minus a discount amount and cost of flotation or your cost of issue. Cost of redeemable preference capital can be calculated using the formula here. So KP D plus 1 by N, RB redeemable value minus net profit, so divided by redeemable value plus NP by 2, average of redeemable value plus net profits multiplied by 100. Now this only if you D is replaced by I, then the formula will be same. as that of cost of debenture before tax. Only the D is there is I, here is the D. Only D and I is different. And a redeemable preference share having no tax benefit, so it is not calculated after tax. It is only before tax formula. No tax benefit. So only one formula is used for calculating if the redeemable preference shares is redeemable. And a different components have been, this is explained in preceding episode also, that net proceeds of preference shares, redeemable value or maturity value of preference, number of years after which this is redeemable. Okay, and dividend on preference shares, this one. Now when the preference shares is irredeemable, not redeemable, perpetual, then when the preference shares is redeemable, then so let's take one simple problem illustrations to explain. So it is problem taken assuming it is perpetual. Okay, here this is, so company issues 1000 10% preference shares of rupees 100 each. So this company is giving 10% dividend every year annually, and number of shares issued is 1000 and each share value is 100. This is at par, and the cost of issue is rupees 2 per share. Calculate the cost of preference capital if these shares are issued at par, at a premium of 10% and at a discount of 5%. Then what will be your cost of preference dividend in each case? So when if it is issued at par, the same formula will be used at a premium, at a discount, but only the amount of net profit will be changed. Net profits will be changed. Okay, D by NP into 100, and here the D equal, so number of shares issued is 1000 and value of each share is 100. So if you calculate the 10% rate of dividend using, then you will get the rupees 10,000 is annual dividend, and net proceeds, so face value minus cost of issue, because it is at par, no premium, no discount. So then here this is your face value minus cost of issue, flotation cost. So one share issue cost price for issue of one share is 2, and how many shares issued? 1000. So 2 into 1000, 2000. So 1 lakh minus 2000, 98,000 company has received net proceeds on issue of preference shares. It is at par, only issue expenses shall be deducted. Okay, so then you putting this value D 10,000 and NP net proceeds 98,000, and these zeros cancel, so 1098. So you see here 1000 divided by 98, so 10.20%. So here it is 10.20% or 10.2%. Simple. Okay, the same formula will be used for if it is at premium or if it is at discount, but only the net profits will be changed. Now next, when the shares are issued, second point, at a premium of 10%, issue at a premium of 10%, issue at par issue at premium, issue at discount. In different three situations you have to calculate. So say if in every case the formula is same, only the net proceeds will be changed. Here D same 10,000 dividend, and now the face value at 10% premium given in the questions, 10% premium. So premium is to be calculated on face value. So here it is in series. This one, face value plus 10% premium minus cost of issue. So then this 1 lakh face value 1000 into 100, 1 lakh plus 10% of 1 lakh minus issue expenses 1000 into rupees 2. That is 1 shares cost of issue is rupees 2. So 1000 shares issued 2000. So 1 lakh plus 10,000 minus 2000. It is 1 lakh 8,000 is the net proceeds. And now when you put this again here 1000 divided by 108, 1000 divided by 108, so 9.25925, so 9.26. Okay, 9.26. This is now issued at a discount of 5%. So same formula, discount, this time D is the same amount, face value discount is minus, so 5% discount, this is the 5% discount, 5% discount amount minus cost of issue. So 1 lakh, so same 1000 into 100, 1 lakh 1000 number of shares and rupees 100 each, 1 lakh, and 5% of rupees 1 lakh minus 2 rupees 1000, expenses rupees 2 per share and number of share 1000. So 1 lakh minus 5000, here it is 5000, this is 5000 minus 2000. So 1 lakh minus 5000 minus 2000, 93,000. So then this putting the value in formula. So this dividend 93,000 cancel is 1000 by 93 divided by 93. So 1000 divided by 93. So 10.75%. So here it is 10.75%. Okay, so this is we calculated when the preference share is perpetual, and if it is issued at par, if it is issued at a discount, if it is issued at premium. Similarly, if the debentures are issued at a premium, at a par, and at a discount is given perpetual, then you have to calculate in the same manner. But there you have to calculate after tax, before tax. Here no after tax, only before tax. If it is not mentioned in the question, it is before or after tax, then you calculate always after tax. Okay, so now here I have given one simple problem for your practice. So this one questions I have given you on this for your practice. So this is one questions, all of you practice and write in the chat box the cost of preference share capital if it is issued at par, if it is issued at premium of 10%, and if it is issued at a discount of 5%. Alright, so all of you practice it and write in chat box your answers. Preference share is redeemable, then the formula is explained you. So to understand this redeemable preference shares. If you have not seen the redeemable cost of debenture, then you see there, and also you will understand this thing in a more clear way. Okay, so the company issues 2 lakh 10% preference shares, which is redeemable after 5 years at a premium of 10%. So this is the cost of issue is rupees 5,000. Calculate the cost of preference capital. So this is the condition is that issue of shares at par and redeemable at premium. This one, very simple formula. This is. So solution, calculation of cost of redeemable preference shares. So Kp, so D plus 1 by N redeemable value minus Np into 100 divided by average of redeemable value and net proceeds. And here the all elements calculated individually. D 20,000, so 10% given in the questions, and the net proceed is the face value minus cost of issue. So cost of issue is given in the question 5,000, so 1 then 2 lakh minus so 5,000, 1 lakh 95,000, and redeemable value is maturity value, face value plus 10% premium 5,000 and face value plus 10% premium. This is the redeemable value. And 2 lakh plus 10% of 2 lakh 20,000, so it is 2 lakh 20,000 redeemable value. Now this all components we are putting in formula. So here 20,000 dividend 1 by 5, so N is 5 years, so you can write here N, this here I am writing N equal 5. After 5 years it is redeemable as it is given in the questions. Okay, so here the 2 lakh 20,000 plus 2 lakh 95,000 and divided by 2, so average you will get 2 lakh 7,500. And now when you calculated this value 2 lakh 20,000 minus 1 lakh 95,000, so difference is 25,000. At 25,000 divided by 5, it is 5,000. So here 20,000 dividend and 5,000 of this value. This whole value is 5,000. Okay, you check it here using calculator. So here 2 lakh 20,000 minus 1 lakh 95,000, so divided by 5, it is 5,000. Okay, so this 5,000 we got it. And here 25,000 average 2 lakh 7,500 and 25,000 2075. Now let's divide 25,000 divided by 2075. Okay, so here this is divide 25,000 divided by 2075, so 12.048, so 12.05%. okay, 12.05%. Alright, so this is your cost of redeemable preference shares, 12.05%. Okay students, thank you very much. So all of you go through it, practice it, note down in your copy. All right, okay, thank you.